So let's hold that as the highest probability outcome.
Yeah.
Let's switch to what the hell do people do if you're right? If that actually occurs.
Well, at what level are we talking now? Are we talking personally, investment, or what?
So let's focus on the investment side. The personal side, there's plenty of information out there, but from the investment seat, what do people do in terms of, one, preparing for this, and then two, if it actually occurs, how do they act or think through the various opportunities that present themselves?
So let's ignore profiting from it for now. We can come back to trading it. That's a different thing. The average person, there's going to be a lot of job losses just because companies will not be able to afford it. This government's going to have to try and support companies. They're doing that in China. There is going to be, so you've got a significant chance of job losses. That's the main thing. You have a significant chance of medical expenses in the United States, which is a big problem with the system here. So it is an economic event for most households, and a significant economic event. Are you ready for that? And that means, and one of the best pieces of advice I was ever given was given back to me in 1991, which was, he who has cash in a recession is king.
I like to say, he who has cash makes the rules.
Yeah.
Right?
But the point being is, whatever you do, just have some cash at hand. This is not a financial event where we have to worry about the banks. Sure, it might morph into something, and I'm not making predictions on that, but just have some cash, because just make sure you've got the availability to deal with this. And maybe I'm wrong. What have you lost? Nothing. But what are you? You're more prepared. So that's, and and I've been, and it won't be many of the viewers or listeners to this, but if you are approaching retirement, again, at Real Vision, we've done this, screamed and shouted about the allocation people have in their pensions. They are taking too much risk, hoping to reach that magic number. Well, if I am right, then the downside is enormous and it won't recover for a significant period of time, over which period people are going to get laid off or retired. So in which case they don't get to buy the dip. So you have too much equity, you have too much credit, and you've never owned enough bonds because you've always thought bond yields of 1% aren't worth it. Well, this is why you learn that bonds are the greatest thing on earth.
So you've been long bonds.
Yeah.
Obviously done very well there.
Yeah.
We've seen Treasury yields go to very low levels. Walk us through kind of your current view of the bonds and in light of the Treasury yield movement.
Yes, I have been hoping for a sharp pullback. There will be a point where you get this gut check that usually happens in the middle of these. And again, this is from experience of trading these. You get a movement against today because the central banks announce something and everyone thinks it's going to be safe. You have to look through that and say, well, what are the central banks going to do to this situation? Nothing. There's nothing they can do. All they're doing is sowing the seeds of the recovery in due course. That's what central banks do. And so any opportunity to buy bonds, you buy bonds because rates are going to zero everywhere and they're probably going negative. Now, everyone goes, negative bonds, never going to happen. You tell me that when the stock market's down 50% and all your other assets are falling and the credit market's blowing up. I'll pay 2% all day to have my money back. People don't understand the value of getting your money back versus the interest rate. And it's the value of getting your money back that's so important. So I think bonds will go negative. They're negative all around the world and have been for years now. And that hasn't blown up. It's a death of the banking system over time, but it's not an instant nuke button.
Is it fair to say that you look at bonds in this kind of depressionary type environment, if that occurs, as the best opportunity out of the worst opportunities?
But they're a call option because, right, the Fed aren't going to raise rates, so bonds aren't going to move against you. I think in price terms. If all hell breaks loose, you'll get your money back in bonds. But if all hell breaks loose and the bond price rallies, which it will do, you'll make a shit ton. So it basically looks like a call option in an environment like this. This is why people like Stan Druckenmiller makes all his money from Eurodollars and bonds, because they have such a skewed risk reward. Also, equities move around human behavior. There's no anchoring to equities. That's why valuations go up and down. Eurodollar futures are anchored by the interest rate. Yeah, they can move a little bit away from where the Fed funds rate is or whatever. So basically they have to reflect economic truths. One way or the other. They can get a bit ahead of the truth or behind, they can get it wrong, get it right. But generally, over time, they have to follow where the interest rates are. The long bond is basically that plus future inflation. That's it. So you have a clean macro variable to aim for. So if you're just forecasting where rates are going, you can trade Eurodollars. If I say rates are going to 0, what you should be saying is Raoul thinks Eurodollars are going to 100, and therefore they're currently trading at 99.40. Therefore, there's another 60 ticks upside. Therefore, can I buy the calls? That's how everybody thinks when you think of Eurodollars. And I've spent the best part of the year trying to educate people about bonds, because the narrative driven by the investment industry is bonds bad, equities good, and it's wrong, because and when you look at in price appreciation terms, bonds have pretty much outperformed equities over the long run for a very long time now, because in price appreciation terms they're so phenomenal. But the little trick, the little hoodwink from the asset managers firms is, oh, look at the yield. Well, that's like just saying equities dividend yield. No, it's the price. And the price appreciation on bonds has been truly extraordinary as this massive demographic wave of people, the baby boomers, has come through and dampened inflation and dampened growth. It means that bonds have exploded and bond yields have fallen.
You think that'll continue?
Yes.
Got it. How do you think about like that long bond position that you have, taking profits, doubling up, just kind of directionally you're correct?
Yeah, so I doubled up and went kind of max limit long, and that's also the advice that I gave to in Global Macro Investor, which is the kind of higher end research service, and also in the kind of Real Vision Pro stuff. So I just said, listen, this is the time to take the maximum risk, because I know the narrative, I know where it's going, I've seen this before. Everyone's going to panic. Be ahead of the panic and make money from it. So now we're in the middle of that, where the narrative is caught up with the reality. Right? You didn't shake my hand when we walk in, right? So that's narrative reality meeting.
Not because I don't like you, just,
No. But,
I read from the CDC I'm not supposed to shake hands.
I've got my hand sanitizer, right? So that is the narrative catching up with where the markets are. So the market, we've got the cut, which is what the bond market was after as well. The bond market's telling us we're going to get another cut at the Fed meeting, so the Fed will go 100. I love it on Twitter now, because you can see where the narrative is. The narrative is, oh my God, the Fed, they're idiots, they're cutting. How's this going to help? What they're not understanding is what the forward narrative is. The forward narrative is, this is not a recession, this is a potential depression. You have to do anything you can do to stop that happening. And secondly, if you understand that the US is about to start testing for coronavirus in larger numbers over the next 4 weeks, we're going to go from whatever we are today, 100 and something cases or 200 cases, and we're going to go to 2,000, and we're going to go to 10,000 at an unbelievable rate. And in an election year, you are incentivized to panic as a state, local authority, government, everybody.
Same thing like war, right? Is and anytime that you can be the one in charge in a time of chaos, panic, uncertainty, etc., there's a higher likelihood that you will stay in office, because the transition scares people, right?
Yes. Although I do think that Trump made, and it's too early in the election, but to understand what's going on, we don't even know whether it's going to be Biden or Sanders or whatever. But Trump made a very bad error by the political error was getting rid of half the CDC. Okay, fine, whatever, that's politics. When he had to stand up in front of the nation and say we've got a problem, like Boris Johnson just did, and I don't like Boris Johnson, but I was pretty impressed with him saying what he said.
Except for he said he went to the hospital and shook everyone's hand and he's fine.
Because he's an idiot.
But go ahead.
But he's an idiot for saying it as well. Because because that was the moment people did with HIV. It's like, this is not the same as HIV. This spreads by hand. So Trump didn't say anything apart from, I'm going to put Mike Pence to look at it. It's not really important. They spread the flu narrative that still won't die down. And that was irresponsible, because if we find out that in 6 weeks' time we've got 50,000 cases, then all hell is going to break loose. And because of the freedom of travel that's still going on in the United States, it is not a small probability.